If you, at the age of 15, started to invest $20 a month into a low-cost S&P 500 index fund back in 1969, you would have had about $25 million just before your midlife crisis at the age of 45. Just kidding, I made that up. But investing back then would have definitely been a really good idea because the price of the index has been going up and up ever since. If you zoom out on the graph, it looks like it can't possibly just keep going up like this forever, and with everything happening in the United States and around the world right now, many young people have doubts about investing. I mean, if they somehow even have extra money after the necessities that they could possibly invest. Is it too late now? And what should people invest in? Of course, there are all kinds of fantastic alternatives to investing, such as buying expensive designer clothes, gambling, and of course, cryptocurrencies. It's June 2024, and you're watching the 5th episode of Money Boost. Warren Buffett, the Oracle of Omaha. When Buffett was 11 years old, he was still eating dirt at a playground. Oh wait, wrong notes. That was me, actually. Maybe that's the reason I'm making YouTube videos instead of doing something useful. But anyways, when Buffett was just 11 years old, he, together with his father, visited a stockbroker in person to buy his first shares of a company. 3 shares of Cities Service Oil Company, to be precise. This was the very beginning of Buffett's investing career. Nowadays, you can do the same in just seconds by opening a trustworthy, definitely not government-controlled app on your phone like Robinhood. Back then, index funds, which are a collection of different stocks, didn't even exist yet. By buying index funds, you can invest in the whole market, or even many markets around the globe. This way, you are diversified and can enjoy the benefits of growing economies. But times were different back when Buffett was 11 years old. In 1941, the United States was about to experience the biggest economic boom in history. Even though index funds didn't exist yet in the 1940s, the S&P 500 did, which tracks the performance of the top 500 most valuable companies in the United States. If S&P 500 index funds existed, and you invested $1,000 back in 1941, your inflation-adjusted return would have been 819% after 20 years, totaling $9,196. And if you invested $1,000 in 2003, your investment in 2023 would have been 383%, totaling $4,834. So in this example, the growth rate for the top 500 most valuable companies in the US is slower, but comparing 40-year periods between 1940 to 1980 and 1980 to 2020, the latter resulted in significantly higher returns. The returns just depend on what's happening in the United States and around the globe. That's why it's a good idea to dollar cost average, meaning you invest about the same sum each month over a longer period of time. So consider canceling a few of your OnlyFans subscriptions and spend that money on index funds instead. If there are any larger drops in the price and you have money to invest, taking advantage of events like COVID and other recessions is a good idea that could help you beat the market in the long run. Right now, in June 2024, the S&P 500 is at all-time highs. It might come down a bit, or more than a bit in case of a recession, but in the long run, nothing really points at the price not continuing to rise at a similar historic rate. Some of the most valuable companies, like Microsoft, Apple, and STD contractors, probably won't continue rising at the same pace just because their market caps are so high that it requires more and more money to support the same growth rate. But there are always new companies rising that have the same opportunities to become just as and even more valuable in the future. Fear of the future is one of the most common things young people mention in surveys about their investing plans. Many mention that the uncertainty in the world is putting them off from thinking long-term. While there's truth to it that the world has problems, I also think that social media is spreading fear and anxiety too much. I mean, just think about the early 1940s when Buffett first bought some stocks. The US was just coming out of the Great Depression. World War II was at its peak. For a while, it even looked like the US was going to lose the Pacific War. There was a major risk of a nuclear war, and geopolitical tensions between countries were high overall. The U.S. struggled with many issues, like labor strikes, rising communist ideology, returning servicemen from the war who quickly needed a lot of support programs, and back then, McDonald's didn't even deliver food yet, so you had to actually go there to eat. So obviously, there were many issues in the world back then, probably more so than right now. But what was different was the mindset that people had. Even with all these problems, people believed in themselves. They believed in America. They wanted to make America great again. Great for the first time. I think that social media has played a big part in problems like mental health. It's like a constant stream of bad news. The bad news has always existed, but people didn't hear about it as much. While it's important to talk about the issues we face, it's probably also a good idea to limit the time you spend on social media and live in the real world instead. But of course, there are real problems too that didn't exist before, at least to the same extent. One major thing that might prevent young people from investing is simply the fact that in many places, the living costs are too high compared to income, so there's simply no money to invest. Click the like button if you're broke, or even if you're not, just click it in any case, or there will be consequences. The earlier you start investing, the better. Your investments keep growing faster and faster as time flies by due to compound interest. Even a small difference in the sum you invest can make a big difference when we talk about decades. It used to be so important to go to school and do well there if you wanted a good job, and it still is to some extent, but many have also started to look for alternative ways to make money. That's why you see like every other 17-year-old kid running a dropshipping store, or pretending that they make money trading crypto, but then they actually just sell a course instead. In the good old days, you could just rob a bank and get away with it, since they didn't even have surveillance cameras. Some young people do have money. Maybe they got a good job that pays fair, and they actually have money left over after all the bills. According to some studies, even those who have money to spend, surprisingly often don't invest much, or at all. Instead, they spend their money on materialistic things, like clothes and cars, that will instantly drop in value once purchased. It doesn't make a whole lot of sense to me, since you can relatively easily grow your investment portfolio to really impressive sums as long as you stick with it long term. This way, you can secure financial freedom later in life and for your children. So no, it's definitely not too late to invest. You just have to be smart with it. And of course, it's a good idea to diversify your investments. Index funds are a great way to do that. You can buy index funds that hold shares from companies around the world or just from certain countries, areas, and industries. If you're smarter than most other people, you can also try to do some research into companies and pick the ones you think will perform the best. If you're even smarter than that, like me, you can also day trade stock options that expire the same day, giving you the chance to 10 times your money in minutes. None of this was financial advice. Don't sue me if things go wrong. This was the 5th episode of Money Boost. Thanks for watching and have a nice life.